I want to welcome everyone to the video for error corrections and change of estimates. I like the error corrections because we're not going to go through a lot of examples because it's more of looking at the problem where they're at. And it's my philosophy of life you have to figure out where you're at, where do you want to go, and how do you get there from here. Well, fixing errors is the same process. Is what did they do, what should have been done, and how do you get there from here? How do you fix it? So that's my philosophy. And basically you look at all errors in the same manner, because you first decide what did they do and then what should have been done, and then you try to see how do we fix that. So first example we have is Acme Company sold equipment and recorded the following: cash of $18,000, accumulated depreciation for $6,000, equipment was $15,000, and gain on sale of equipment was $9,000. That does look correct. However, when you looked at the books, you discovered that they failed to record depreciation of $2,300 in the year that they sold it. So what we want to do is do the journal entries. We're going to assume two different prospects. First, the books are still open, and second, the books were closed. Maybe you discovered this sometime in January or late January, and if the books are still open, you do it one way. If the books are closed, we're going to do something different. Okay, so what we have here, if the books are still open, what we should have had is the cost was the $15,000. Put the wrong number down. Okay, that was the cost of the equipment. Accumulated depreciation was the $6,000 plus the $2,300, which would give you $8,300. So the book value then was $6,700. We sold it for $18,000. The book value should have been the $6,700, which means your gain should have been $11,300. Okay, now if one way of doing this is what we call the shortcut method, we simply would debit depreciation expense by $2,300 and credit gain on sale of, I'm going to put equipment, it could be asset, however you want to word it, and that's $2,300. Okay, so if you notice now, our gain was $9,000 plus the $2,300, and depreciation was $6,000. Now it's $8,300 for the depreciation expense. So that's kind of the quick phase. The problem is you don't have much of an audit trail there. So the better way of doing it is basically we'll come through and we'll reverse this entry up here. So we'll have, we just want to reverse this. So we debit and then debit the equipment and then credit accumulated depreciation and credit the cash. And that will be for the amounts that we had up there. The $9,000, $15,000, $6,000, and $18,000. Then we want to record the depreciation. So we would debit depreciation expense. That would be for the $2,300, and we would credit the accumulated depreciation for $2,300. So that brings the entry up to where it should have been. Then we'll record the entry like we had before. So we would have equal to cash. And since I did it that way, I think I can just do this. I'll see. Yeah. I'll take those two over there. And the cash is still $18,000. Accumulated depreciation now would be $8,300 because you had the 6 plus the 23. The equipment still costs $15,000, and that's $11,300. So that's another way of doing it that leaves the audit trail. This one reverses the original entry out. This records the depreciation like you should have done, and then this records the entry as it should have been recorded. Like I said, this will give you the same results. Now, the next part B, it says, what do we do if the books are closed? Well, if you close the books, we don't do anything. There's no entry needed because depreciation expense will reduce the net income, but your gain increases the net income, and it reduces the income and increases the income by the exact same amount, the $2,300. So it's a wash. So it doesn't affect income whatsoever. So we just kind of let it go. We can ignore it. Okay. Now, inventory errors. This is one, the first one I go 2020 is 9,000 overstated for the ending inventory, and in 2021 they were understated. Now we're at the end of 2021 or beginning of 2022, and inventory is a unique feature in that the third year it's self-correcting. So if they're more than 3 years, if it's more than 3 years out, or 3 years out or more, you don't worry about it because it's self-correcting. Okay, because if the ending inventory is overstated, cost of goods sold would be understated, which makes income overstated. But the next year it's reversed. The beginning inventory is overstated, which overstates the cost of goods sold, which understates the ending inventory or the income. So after the second year, it works its way out of the system. Okay, but this, we're not 3 years out. So in 2020, it's overstated by $9,000. So that means our income was overstated because cost of goods sold was understated, which overstates the income. So we need to reduce the retained earnings because the books are closed, and remember, income is closed into retained earnings and it's overstated. So that would be $9,000. And we would credit earnings, there we go. We would credit then inventory because it's overstated, so we need to reduce inventory by $9,000. Okay. Now the next one we have is the inventory is understated by $12,000. Well, that's going to have the opposite effect. If it's understated, it's going to overstate the cost of goods sold. So if the books are still open, we would want to increase the inventory by, oops, I have 17,000 there, don't I? I forgot to change that one. 12,000. Okay, I'll just change it there. Okay, 12,000. And we want to reduce the cost of goods sold by 12,000. Okay. Now, if the books are closed, well, we still do the inventory just like before because we need to increase inventory by the 12,000. However, we want to then increase retained earnings because that's where it's closed into. Income is closed into retained earnings by 12,000. Okay, and that's the two inventory. That's the two errors I'm going to do. Those are the two most common ones. Like the other ones, though, like I said, look at what did the company do. What should they have done, and then how do you get from where they're at to where they should be? And that's all you need to look at. And look at how does it affect income, and has the income been closed into retained earnings or not? And then you take it from there. Okay. Now, change of estimates. On this one, we have Faulkner Company. How much time? I got 9 minutes. Okay. Faulkner Company purchased a machine in 2015 for $30,000. The life was for 5 years with the 2,000 residual value, or salvage value, or trade-in value, whatever you want to say it. We're going to use the straight line depreciation method. And during the 3rd year, the company figured out they thought that the machine would go another 5 years instead of and with no residual value. So we're going to change our estimates. We're changing the length of the life of the equipment and the residual value. So the first thing we need to do is figure out how much depreciation have we taken so far. So in year 1, if you remember straight line, so the machine cost us $30,000 minus the residual value of $2,000 divided by 5. We'll keep this easy. So that's $5,600 a year. So we take $5,600 the second year because it's straight line. And then so we've taken a total of $11,200. So we calculate the book value. So we have $30,000 and we've taken $11,200 of it. So that would be 30,000 minus 11,200. So it's 18,800. Then we just simply calculate the new depreciation based on the book value. So we have equal 18,800 divided by 5, because they thought it would last another 5 years, because we haven't done 3rd year yet. So the next 5 years we'll take 3760 as our depreciation, and that's all you have to do. Now I have a note here. If you change depreciation methods, that's considered the same thing as a change of estimate. So you go through the same process. If we go to straight line to double declining balance, for instance, you would calculate the book value, and then you put the balance based on double declining balance, or some of the year's digits, or one of the units of production, one of the other methods. Or if you're going the other way, you can just do the same thing. Calculate the book value, the carrying value, the book value. That's what the 1880 is, and then take it from that point forward. So a change of depreciation methods is considered the same thing as a change of estimate. Okay. Now we're going to do a change in principal. And what we have here, Miller's decided to change from the average inventory to FIFO system with the following information concerning the change. Okay. This is what they have calculated out for you. We're in a 25% tax bracket. So for FIFO, before 2020, if we'd use FIFO, it was 20 million, 14 million, 18 million. The average cost system was 12, 8, and 16, and there's the difference, 8, 6, and 2. Okay, so now what we have to do is change the principal. Well, the first thing we'll do is we'll debit inventory for the 8 plus the 6, because we need to increase our inventory by 14 million, and that's what we have there. And then income tax payable, because it's going to increase our taxes, because it makes it retroactive, and that's equal to the 14% times the 25%, which would be 4 million. That's all one big word now. Income tax, payable, there we go. And then we would have retained earnings, would be the difference of 11 million. Okay. And then I have a note, inventory methods have to be the same for accounting and tax reporting. And you have 6 years to pay the difference. So we'd have up to 6 years to pay this $4 million. But the new laws state that inventory methods for accounting purposes and tax purposes are the same. Okay, so what we have here now, this is the comparative income statement. We would have 18 for 2021, and 2020 would be the 14, which is the right there, 14. And the income tax expense is the 18 times 0.25, which is 4.5. Okay, that gives us 3.5. So our net income then would be 18 minus 4.5. And this is